Alright guys, and here on our news from Times Tabloid, it says if XRP hits $2,000 overnight, what is your first move? Imagine blinking your eyes open tomorrow morning, reaching for your phone and opening your portfolio app only to find that XRP is trading at exactly $2,000 per token. You rub your eyes, restart your phone, and check again. It is not a glitch. The balance on your screen has completely shifted into multi-million dollar territory while you were fast asleep. This exact scenario went viral across social media after a fascinating thought experiment was posted on X by crypto pundit John Squire. He bypassed the usual chart debates and directly asked the community a heavy psychological question. If an extreme price explosion like $2,000 happens overnight, what is your very first move? Do you cash out completely, hold out for more, or use advanced wealth strategies? So in this video, we are breaking down the tactical ways the community plans to handle life-changing liquidity and why true market mechanics require a unique blueprint. So let's look at the reality behind the thought experiment. So let's start with our very first question. What happens to investor psychology when an asset hits $2,000 overnight? When John Squire published this hypothetical scenario, it instantly triggered a massive wave of engagement. It highlights the sharp divide between short-term speculative retail thinking and long-term wealth preservation. For years, people have focused entirely on predicting exact price targets, but very few focuses on the reality of execution. So my opinion is that an overnight move to $2,000 would cause a complete psychological shockwave. Most retail participants say they will hold forever, but when real generational money is flashing on a screen, panic selling out of sheer shock is the most common outcome. However, what makes the XRP community unique is that they did not talk about buying sports cars or beach houses. They talk about complex structural asset allocation. This shows that the community treats their digital assets as infrastructure rather than just lottery ticket. It proves a level of maturity that most other crypto networks completely lack. Right? Now, our next question is, why are the savvy investors planning to leverage rather than to sell? One of the most striking responses to Squire's post came from community member Dan Dohashek. Right? Dan Dohashek. So let's just highlight this part. He stated plainly that even a $2,000, he would not sell a single token. Instead, his strategy revolves around holding the digital asset as pristine collateral and borrowing traditional capital against it to fund other cash flowing setups. So my personal opinion on this approach is that it mimics the exact playbook used by the ultra-wealthy and traditional finance. If you own an asset that is rapidly appreciating or serving as a foundational global utility, selling it triggers a massive tax event. By keeping the asset locked up and utilizing debt against it, you preserve your underlying position while unlocking immediate liquidity. This is a highly advanced strategy that moves away from standard retail behavior. It turns the asset into a personal credit line, ensuring that you never lose your seat at the table while still capturing massive material freedom. Now, how do you diversify millions without damaging your core position. Another community member here named Tony. So let's just highlight this part. Tony laid out a hyper detailed approach that balances immediate liquid security with long-term wealth compounding. Tony explained that he would execute a strategic exit of exactly 2,000 tokens while keeping the vast majority of his stock completely safe. The proceeds from the sale would be spread across a high-yield savings setup yielding between 4% and 5% annually, alongside automated yield reinvesting instruments. Now, here's my opinion in Tony's method, which provides the perfect balance for mitigating emotional fatigue. Selling a small, calculated percentage ensures that you lock in undeniable financial peace for your household immediately. Putting those gains into steady instruments yielding 4% to 5% means you are generating thousands of dollars in passive income every single month without risking your principal. More importantly, Tony mentioned redirecting capital back into utility-driven digital assets and placing the entirety of those structures into irrevocable trust. This moves the conversation away from temporary wealth and directly into multi-generational protection. So, what does this thought experiment reveal about the long-term vision? The ultimate takeaway from John Squire's viral post isn't about $2,000, it's a realistic near-term target. It isn't about whether $2,000 is a realistic near-term target. It acts as a diagnostic mirror for the community's collective mindset. It shows that investors aren't looking for a quick exit from the ecosystem. They are looking to integrate with it. So my personal opinion as a market observer is that this thought experiment reveals why utility-driven communities survive long crypto winters while speculative meme communities vanish. The focus is entirely on asset preservation, institutional integration, and turning digital liquidity into lasting legacy systems. When your community is actively discussing legal trust, yield mechanics, and asset-backed borrowing rather than just looking for an exchange cash-out button, it indicates a deep understanding of structural finance. Now, here comes our overall conclusion. John Squire's hypothetical $2,000 scenario serves as an incredible psychological and financial exercise. It proves that survival market volatility is only half the battle. The real challenge is knowing exactly how to manage success when it arrives. Whether your strategy mirrors John Dohachek's plan to borrow against your collateral or Tony's structured play of taking partial exits into high-yield setups and irrevocable trust, having a plan before the liquidity shock arrives is what separates reactive participants from true wealth managers. Market dynamics change in the blink of an eye, and those who treat their holdings like real infrastructure are the ones built to sustain the future. And this finally ends our video. Thank you very much for watching and see you on the next one, or you might just as well check this recommended video right here.